Welcome to Wealth Events. Let's get started. Inherited assets. When assets are inherited, they are inherited at their fair market value as of date of death. So whether or not we're talking securities that are inherited, or maybe it's even real estate that's inherited, the cost basis for the person that inherits the asset is the fair market value as of date of death. Let's look at an example. Uncle Bob bought some shares of stock for $10 a share in 1990. Today, those shares are valued at $100 a share. Uncle Bob died today, leaving you those shares. What is your cost basis? Your cost basis is the fair market value as of date of death. You don't owe any taxes on inherited assets, not unless you sell them for more than your cost basis. Let's say 6 months later, you sell the shares at $110 a share. You have a $10 gain per share that will be taxable at long-term capital gains rates. It does not matter what your holding period was. When there is a gain on an inherited asset, it is always taxed, under current tax code at least, as a long-term capital gain. To bequeath an asset is to leave it to someone in your will. It sounds really fancy. I always feel like I should be wearing a crown when I say to bequeath an asset. It's just a fancy way of saying it's left to someone in your will. What would happen if instead of Uncle Bob passing away and leaving you these shares, he gifted you the shares? The tax consequences will be totally different. So let's look at that. If Uncle Bob, he didn't die today, but he gave you a gift of securities that he purchased for $10 a share in 1990. What's going to happen now is you're going to assume the original cost basis and holding period. Original cost basis and holding period. So that if you were to sell those shares 6 months later at $110 a share, it wouldn't be the $10 gain anymore. Your cost basis would be $10 a share. It would be a $100 gain per share. Still taxed at long-term capital gains rates because your holding period is a year and a day or longer. Life insurance. We need to understand how life insurance works for tax purposes. The face amount of the policy, let's say, is $100,000. The insured is Sam, and the beneficiary is Bonnie. When Sam dies, Bonnie will receive the death benefit, the policy face amount. Life insurance death benefits are tax-free to the beneficiary. If Sam owns the policy, the $100,000 is included in his estate for estate tax purposes. If someone other than Sam was the owner of the policy, let's say his wife Bonnie was the owner of the policy, then the death benefit is not included in Sam's estate. That concludes our discussion for wealth events. Practice the topic quiz, and I'll see you in the next video.